We also have some data of a survey that's been done and that asked the question to a lot of respondents, where will they be spending on this festive season? And the answers are sort of evenly spread out, but I'll just sort of take them up here. Puja, Diwali supplies, 35% of the respondents seem to be suggesting that they'll spend for that. Festival groceries, another 26 odd percent. Home renovation, 13%. Beauty fashion, 12%. Smartphones, electronics, white good appliances at 6%, and automobiles finally at just 4%. Coming to you, Feroz, and this is to focus on sip by sip. What are the sips that we should be looking at in terms of the current macro environment, and as I always argue, for long-term investors without the greed factor and therefore consequently lesser fear as well?
Great. So I think like Ajayji said, if you buy a single stock, you could lose half your money. So in mutual funds, I would recommend 5 different mutual funds for this Samvat. 5 ones which can be complementary to each other. So one of them would be SBI Contra. That's first one. Kotak Emerging Equities. Then you can look at Invesco Multi-Cap Fund, ICICI Focused Equity, and lastly a large cap fund which is Franklin Blue Chip. So if you look at these 5 funds, if you're buying these 5 funds for 1,000 rupees each or even 500 rupees each, you're going to have 160 stocks in your portfolio. Now all of them are not going to go down in a jiffy, right? So point is this: if you consistently invest, making double-digit returns with the tax efficiency which equity provides, unlike debt, is very, very likely. Of course, it's not going to be a linear curve. Anytime when the market falls, you have to look at data. There are 31 funds, equity funds, which have finished 25 years in India. If somebody were to invest for 10 big years, the unluckiest investor has not lost capital.
Okay. So, and Lady Luck has a major role to play, Feroz, and like you and Ajay Srivastav have been observing the markets for decades, luck certainly is a key factor. I'm coming to you, Sugandha, on a quick answer really in terms of allocations. Now for the average investor and not for the sophisticated investor, if you can quickly explain how much should gold be part of a standard portfolio?
So I think, Siddharth, a standard portfolio should ideally contain 10 to 15% allocation into gold. So it could be in various
And what kind of gold?
Be it you buy gold bonds, which also offer the additional benefit of 2.5% annualized interest, or you may buy gold ETF, which offers significant liquidity, or you can even do SIPs in gold mutual funds. So you have various avenues. This is separate from your consumption perspective. For consumption perspective, you can certainly buy jewelry because they give you touch and feel and also are a good option to invest. But otherwise, if you're looking solely at investment perspective, I think these 3 avenues are very good to invest into gold, and your allocation should be 10 to 15%. But yes, with the concerns surrounding global economy, there are a lot of concerns about slowdown, recession fears, rising inflation, and geopolitical risks are still there. So I think allocation can even be increased to 20%. But yes, it all depends on your investment objectives, your goals, and your risk appetite. But then I would certainly say 10% is the bare minimum that you should ideally invest in gold.